What's up, everyone? It's me here. If there's one thing that I wish I knew when I was younger, it would be this. Because after countless hours of reading books, talking to experts, and investing over $1 million of my own money into the market, I realized that these are 5 common investing mistakes that are keeping you broke. And once you understand what they are, the sooner you can avoid them so that you can finally start investing, building wealth, and hopefully one day retiring early. Although before we start, as usual, if you appreciate all the information and research that goes into making a video like this, it does help out tremendously if you subscribe or if you want to show your support. Either way, thank you guys so much, and now let's begin. Alright, so before we talk about some very important mistakes that could impact your net worth, we first have to cover what is arguably the most basic foundation of investing, and that would be having a budget. The reality is that more than 61% of Americans live paycheck to paycheck. And according to another survey, only 34% of millennials feel that they have a good understanding of their finances. Well, the good news is that this is something that can easily be fixed by creating a budget. The truth is, there's no reason to invest if you do and even know where your money is going in the first place. Because until you cut unnecessary spending, pay down high-interest debt, and determine how much you can realistically save each month, you're never going to be able to make any progress towards your goals. And the best part is that creating a budget doesn't need to be complicated. In fact, you can do it in less than 5 minutes by following a few easy steps. First, figure out your monthly income by taking your pre-tax salary and then subtracting taxes, insurance, retirement contributions, and any other mandatory expenses to get your take-home pay. Second, add up all of your fixed expenses like rent, utilities, transportation, and minimum credit card payments. Third, calculate your variable expenses like groceries, clothing, entertainment, and travel. And then fourth, subtract the sum of your fixed and variable expenses from your income to determine how much you can save. From there, you can use a budgeting app like EveryDollar or Mint to keep track of your spending and ensure that you stay on target. Doing this will not only help you find areas where you could potentially cut back, but it also helps you become more mindful of your spending, so that you don't accidentally buy something that you don't need. After all, the entire point of investing is to grow your money, so that you can eventually use it for something else later. So unless you know exactly where your money's going, you'll never be able to truly maximize its potential. Second, not knowing what to invest in. If you've ever tried to do any investing, then chances are you probably noticed just how many different options there are to choose from. But since we're not financial advisors, how could you possibly know which one is right for you without losing money? Well, in terms of where to begin, it really depends on 2 things: your timeline and your risk tolerance. See, investing is not a get-rich-quick scheme, and it's likely not going to work out the way that you see it. Just ask anyone who invested in GameStop stock. Even though they were told not to by pretty much every financial expert on Wall Street, they went ahead anyway and lost a lot of money. So even though there are countless people claiming to have the secret to success, the reality is that the best long-term strategy is usually the simplest approach. For example, Vanguard found that almost 90% of investors follow a strategy known as dollar-cost averaging. This involves investing a fixed amount at regular intervals regardless of market conditions. That way you're buying more when prices are low and less when prices are high, which theoretically should offset each other out over time. This is exactly what Warren Buffett has been doing throughout his entire career, by buying a little bit every week and holding on for the long term. And since he's done this consistently since 1942, he's been able to generate an average annual return of 18%. Now granted, it is easier said than done. And if you're new to investing, it might be worthwhile to consider starting with a robo-advisor like Betterment or Wealthfront. These are online investment platforms that automatically manage your money based on your preferences, and they typically charge a small fee anywhere between 0.25% to 0.5% of the total assets that they're remanaging. That way I need to worry about picking individual stocks or timing the market, because they handle everything for you based on your needs. Third, investing without a plan. One of the biggest problems with investing is that most people do it without a clear purpose in mind, and instead, they simply buy whatever looks like it might go up in value. But unless you have a plan going into it, it's highly unlikely that you'll reach your goals. For example, when Tesla's stock was trading at $17, it had a lot of potential for explosive growth, but most investors had no idea that it would eventually be worth hundreds of dollars per share. On the other hand, Circuit City looked like a great investment because it was a household name, but no one foresaw that the company would go bankrupt. And that's why it's so important to have a well-thought-out plan before you invest. So first, you have to figure out your goals. How much money do you want to invest and by when? What is your expected rate of return, and what are you investing for? Is it for retirement, your child's education, or just to have some extra cash on the sidelines in case something were to happen? Second, assess your risk tolerance. How comfortable are you with the possibility of losing money? Generally, the higher the potential return, the higher the risk, and vice versa. Why? So you have to decide how much volatility you can handle mentally, because no one wants to watch their investments drop in value. Third, determine your investment strategy. Are you looking for passive income or long-term growth? You want to focus on dividend-paying stocks, real estate, or maybe crypto? Or perhaps you're interested in starting your own business. Fourth, diversify your portfolio. Don't put all of your eggs in one basket. Instead, spread your investments across different asset classes, industries, and geographies so that you're not too exposed to any one particular investment. And lastly, review and rebalance your portfolio regularly. Make sure that your investments are still aligned with your goals and risk tolerance, and make adjustments as needed. Fourth, not investing at all. Although this might sound crazy, the truth is that the biggest enemy to making money is oftentimes sitting right in your bank account. According to the Federal Reserve, the average American has less than $1,000 in their savings account, and with 20% of that being wiped out by inflation every year, it effectively means that you're losing money without even realizing it. That's why it's so important to invest as soon as possible, even if it's just a small amount. Now, of course, it is true that there are better times to invest than others, like when the market is down, but even then, it's impossible to predict where it'll go next. So instead, dollar cost averaging your money is probably going to be the best option for most people. Additionally, you also have to take into consideration something called opportunity cost. This refers to the potential profit that you could have made if you had invested your money elsewhere. For example, let's say you decided to hold on to your $1,000 rather than investing it. 5 years later, that same $1,000 could have grown to be worth $1,417 if you had invested in a high-yield savings account that earned 2% interest compounded daily. Or if you had invested in the S&P 500, which historically averages around a 10% return, your $1,000 would have turned into $1,627. So even though the market goes up and down in the short term, the long-term trend has always been upwards. And by investing early, you're able to take advantage of something called compounding returns, which brings us to our final mistake. 5. Not letting your money compound. When it comes to investing, Albert Einstein referred to compound interest as the eighth wonder of the world, and he who understands it, earns it. But he who doesn't pays it, and that's extremely true. Historically, the stock market has returned an average of about 10% per year. So let's assume that you invested $1,000 and then did nothing for 30 years. And the best part is that today, there are multiple ways to begin investing, even if you don't have a lot of money. Apps like Acorns and Stash allow you to invest spare change from everyday purchases. Robinhood and M1 Finance offer commission-free stock and ETF trading, while Weebly allows you to build a simple website to start your own online business. Now, yes, none of these are guaranteed to make you rich, but by starting today, you're going to be that much closer to reaching your goals tomorrow. With that said, you guys, thank you so much for watching. As always, feel free to add me on social media. Enjoy. Thank you so much, and until next time.